Hey, everybody. Thanks for joining us on this beautiful Wednesday. I hope it's a great day wherever you are. We're going to give everyone just a moment to join.
Brittany, we may need to be in a different link.
I think I found it. Hold on 1 second.
Hey, everybody. Thanks for joining us today on this beautiful Wednesday. I hope it's a great day wherever you are. We're going to give everyone else a moment to tune on in. So grab a water, grab a coffee, grab a beer. We're going to start rocking and rolling soon. And while we're waiting for everybody to tune in, everybody who's here so far, where are you tuning in from? Pop it right in the chat. There we go. And who's going to see us next week in Denver? Anyone making the trip? Scott in Missouri, Mike in Ohio, Hawaii, New Mexico. Wow. Awesome. We're going to give everybody just a few more seconds before we dive into Maria. Got a great presentation for you today. And Michael in Costa Rica. Well, let's get started. Welcome to the third part of a four-part series on how to boost your bottom line, presented by Perkins Co, Craft Beer Professionals, Craft Peak, and Arrive POS. We're excited to have you join for What Your Accountant Wishes You Knew. And just a few reminders before we get started. If you have any questions, please drop them right in the Q&A area. Maria will be glad to take them at the end. And heads up, there may be too many questions for our team to answer during the session, but we'll make sure someone reaches out to answer post-webinar. And we are recording the webinar. It will be sent to your email this week, so be on the lookout. Now, Maria Pearman is a certified public accountant who provides accounting expertise and a deep operational knowledge to the beverage alcohol industry. She has also taught finance and accounting for craft beverage at the University of Vermont, Portland State University, and through the Distilled Spirits Council of the US. Her book, Small Brewery Finance, Accounting Principles and Planning for the Craft Brewer, was published by the Brewers Association in 2019 and is right behind me on my shelf. Highly recommended. Maria's specialties include finance, managerial accounting, budgeting, tax accounting, tax planning and provisions, business strategy, brewery-specific production planning, and ERP software. She earned her BA from the College of Charleston in her home state of South Carolina. She resides in Bend, Oregon. I'm excited to see her next week at CBC. Maria, all on you now.
Thanks, Andrew. Really good to be with you guys. So this topic is what your accountant wishes you knew. And I've worked with well over 100 beverage alcohol companies over the last 12, 13 years. And I just tried to boil it down into, the top 10 things that I think are key takeaways. So in David Letterman style, we're going to go through our top 10 list. And if you don't get that reference, I guess I'm dating myself, but hopefully it's not falling on deaf ears. So we're going to go through this rapid fire style, and we'll just get started starting at number 10. It's better to maximize sales in your own backyard than to open up territories far away. So many people, I think, get caught up in chasing revenue and sort of looking for growth in that top line. And sometimes if that top line means that your brewery in Des Moines is trying to sell beer in Los Angeles, that can be a losing proposition because it is so much more expensive to open up another territory that's far and away. And also the way the industry is changing, people are really dialed into hyper local now, and every region seems to have its own bevy of craft options. So if you are a craft option and you're trying to come in from hundreds of miles away, that's very difficult. Also, to really make a presence in a different market, you really do need boots on the ground there in the form of a salesperson, and that's expensive. People are expensive. So if you have any opportunity to just mine your own backyard or your own small region first for more sales, I definitely recommend doing that before you go further afield. Number 9, merchandise is your friend. I think a lot of us have learned this over the last 18 months. Merchandise is great because the margin on it is about 50%. So you should buy for one, sell for two. And it doesn't require any labor to produce. You're buying a good and you're reselling a good. So it's simple. You're not subject to the 3-tier system for this line of sales, so you can easily sell direct to your consumer and there's nobody in the middle who is taking a portion of the sale. That's assuming that you're selling goods either online or through your retail locations. And bonus for you, if people are already in your tap room, they're already invested and interested in your brand, and you've got a captive audience with no other competing merchandise around. So maximize the opportunity for taproom sales of merchandise. Think about the experience of your patrons as they walk through the tap room. Do you have your merchandise set up so that people have to walk by it in order to get to the counter? Is your beer to go in a refrigerator right by the register? All of these are simple things, but so effective. And also in this COVID era, where everywhere across the country is in different phases of lockdown. So what you might experience is that perhaps indoor dining is restricted and outdoor is a little more lenient. Get a little refrigerator on wheels, a cooler on wheels, and have some of your beer to go out there so that people can just easily grab and go instead of having to go inside to do it as well. So merchandise, beer to go, those are both highly lucrative in terms of margin, and I encourage you to mine that for all it's worth. Number 8, use the data in your POS to maximize taproom sales. Most POS systems have helpful reporting features that allow you to slice data in multiple ways. So you can check out which days and times are most popular, and then use this information to help drive sales to slower day parts. So if you see that Tuesdays from 4 to 7 are 30% less revenue than Thursdays 4 to 7, are there incentives that you can offer to get butts in seats during that slow time? And the data will help tell you where you need to push your marketing dollars and efforts. Also, a lot of this, when we swipe credit cards for sales, you can utilize information about credit card zip codes to find out where your customers are coming from. Are they in the neighborhood? Are they coming from out of town? All of this is really helpful in terms of how you speak to your audience and how you market yourself. So definitely mine through the data there, slice the data, and help it inform your managerial decisions. Another way that you might utilize this is if you're thinking about opening up an additional tap room, maybe there's a way that you can use this information to see where people are coming from. And if they're coming from across town, that tells you there's a demand from people that live in another region. And so it can help point you in the right direction in terms of geographic locations for additional retail outlets. Number 7, you don't have to keep all of your data in QuickBooks or whatever accounting system you're using. I'm an accounting professional and I work primarily in that realm with my clients. And one thing that I often encounter, people think that they need to set up their chart of accounts so that they can see all the detail in the world in their financial reports. And while I understand where that's coming from and it's admirable to some degree, it also can lead to really unwieldy financial reports, very long, very detailed, and sometimes you get paralysis by too much detail that's available to you. So I encourage you to keep the chart of accounts in your accounting software simple. And then if you want to see something like your product mix, then go to your POS software. Or if you want to see information about points of distribution, utilize VIP. You can get a lot of other information from your production software, your inventory management software, sales software, for example. So that is where you can go to get the detail. And in QuickBooks, you keep it simple. And in terms of revenue, maybe you're just looking at packaged goods sales, draft sales, and merch sales, something as simple as that. But keep it simple, keep it streamlined, and then remember you can utilize other areas of your data to get the detail that you want. Number 6, KPIs are extremely helpful. I think of key performance indicators as shorthand for your financial reports. So not to discount the value of full financial reports, that being balance sheet, income statement, and statement of cash flows. Those are very important and you should go through them thoroughly at least once a month. But your key performance indicators are great because they can tell you at a glance how things are looking. So it's like, giving you a shorthand into what those financial statements would tell you in a lot of detail. Some of my favorite KPIs are listed here. So current ratio, debt to equity, day sales inventory, weeks of cash on hand, revenue per labor dollar, revenue per square foot. This is for your retail locations, gross margin, and I've got in parentheses by division. So you want to have your wholesale gross margin and your taproom gross margin separated out because those are two different business models. EBITDA, and of course, net income. So if you have any questions about what those mean and what they measure, you can contact me afterwards. But I just want you to have a quick list of those things that I highly recommend to keep your finger on the pulse of the health of your business. Number 5, the way you talk about your financials should reflect your audience. There's a time and a place for high-level data and a time and a place for detailed data. And I want to give you an example here. So let's say that you are presenting your financials to your leadership team, and your leadership team might include your sales director, production director, CEO, CFO or equivalent, marketing director, taproom manager, etc. So those people in their day-to-day lives, they are not living in the numbers the way an accountant lives in numbers. And for a lot of people, this is boring stuff. So how can you take very detailed, important financial information and boil it down in a way that will resonate with an audience who doesn't natively speak that language? So this is an example of how I like to present financials to non-native accounting speakers, as I like to call it. So you're just looking at very key points like, we've got COGS. We definitely need to know what COGS are in terms of their percentage of revenue. And we need to know what we're doing in terms of how much we're spending on sales and marketing, general and administrative, and what type of EBITDA we're hitting. So another thing that's important here is not only the percentage of revenue, but also looking at budget versus actual and the difference between the two. You see here in these columns, I've got the first leftmost set of columns is for one particular month. And then the middle set of columns is looking at year-to-date figures. And then the third set of columns is fiscal year forecast. And what fiscal year forecast is, in the actual column, that is the actual numbers year-to-date. So in this case, it would be actuals January through August, plus your budgeted September through December. Versus the budget, which is just going to be total budgeted numbers for all 12 months of the year. So this tells you if we stay on track to our budget from now to the end of the year, this is how we're going to end up. So all three of those are quite helpful, and it gives your audience, if they're not natively speaking the language, a way to connect with the numbers without all the detail. Now, if you are coaching one of those leaders individually, and so if you are in charge of the accounting department in your company, ideally you're having monthly meetings one-on-one with each department leader to in-depth go through the accounts that are relevant to them. In those meetings, that's important to go through the detail. But when you're as a group and you want to talk about the performance of a company as a whole, I think that staying a little more high level is really going to drive home the points that you want to get across in a more effective fashion. Number 4, attach margin to everything you sell. I don't believe in loss leaders. I think that if you're selling something, you better have margin attached to it. So margin is revenue minus cost of goods sold. And I'm talking about attach margin to everything in terms of a per SKU basis. This is not simply looking at packaged beer margin and draft beer margin. This is looking at what is the margin on my 4, 6, 12s of my Pilsner. And I think it's critically important to review margin by SKU on a monthly basis. Before a beer is brought to market, you should put it through a vetting process. And that vetting process would be a checklist where there's a section for production, sales, marketing, and accounting. And from a financial perspective, the cost of a test batch should be calculated. And if it doesn't meet those minimum profitability requirements, it doesn't go to market. So not only important to vet a new beer before you put it on the shelf, but it's also equally important to review its profitability month by month to make sure you're staying on track. Number 3, open book management pays dividends. So open book management is the practice of sharing financial data with your team, and leadership should have a full view of financials. That means nothing is redacted in your financials. Everything is open and you're reviewing it together on a monthly basis. Now, as you go deeper down into the org chart, that access will decrease, but even your lowest level employees should have visibility into the revenue, the margin, so that is revenue minus cost of goods sold, and the net income, as well as the actual position versus the budgeted results. So this is critically important to get all of your team members invested and rowing in the same direction. It gives them insight into what are our financial goals as a company, how are we performing to goal, and it helps them start to think in terms of what can I adjust about my day-to-day that will help get us closer to goal. If that's uncomfortable to show your team just strict dollar amounts, you can always couch this in percentages instead of dollar amounts. Number 2, budgeting is the best management tool that exists. I highly recommend going through the budgeting process because it helps to crystallize your goals, and it forces companies to make sure that their vision and their larger goals are still appropriate for them. I mean, usually you'll do your budgeting process right around October. You're getting ready for Q4. You're setting yourself up for the next year. And so it makes you double check your vision and your goals and recalibrate if necessary, specifically in this year where we maybe thought that COVID was done and now we're back in round 2 of it. So maybe your vision and your goals are shifting again. So it's just a way to reset, and every department head should be involved in this process. By getting your department heads involved, that's a great way to create alignment with your team. So then, not after the budget is set, you're going to look at your financials from an actual basis and start to compare them to what your budgeted result was. And that is where the gold is. Every month, you're looking at the variance from the actual to budget and then making decisions on how you can adjust your operations to get closer to goal. So budgeting, best thing that a company can do. And the number 1 point that I want to relay to everybody is that cash flow is more important than profit. Use a cash flow forecast. Cash flow is something that affects businesses of all industries, of all sizes, of all phases of their corporate life cycle. It never ceases in its importance, and it's the lifeblood of an organization. So I'll give you an example. Sometimes you might be tempted to get into a raw materials contract because you can get a lower price on your goods if you buy in bulk, but that may put you in a cash crunch. Whenever you have to buy those materials, you could be in a bad position cash-wise. So I encourage you to make sure that cash flow is protected first and then start to think about profit. So those are my top 10 things that I want to convey to you guys. I hope it's been helpful. And if you have any questions or want to talk further around any of them, shoot me an email, and also happy to take any questions that have come up right now.
Hey, everybody. Thanks again for tuning in, and tons of fantastic information there, Maria. I always love a good top 10 list. And for everyone who's still tuned in, shoot those questions, put them in the Q&A section. We'd love to have Maria answer them for you today. I'm going to keep an eye on that right now. And there is no such thing as a bad question. You have her attention. She is ready to provide you with the insight you're looking for. Well, Maria, while everybody gets their questions together, I've got one for you. We talk a lot about point of sale systems. What are some of your favorite metrics that a taproom manager can use to just kind of get better with understanding data from their POS system?
Well, okay, so kind of 2 different answers. My favorite metrics that a taproom manager should use relate primarily to financial results. So looking at your food COGS or your beer COGS, And then also your labor cogs, and labor should be boiled down into front of house, back of house, managerial. So keeping a handle on what those are as a percentage relative to revenue, and measuring those against your benchmark. So if you have a benchmark of having food cogs at 30% or 33%, what are you doing in actual results, and what changes could be made to move closer to goal. And also, I think it's important to point out that when you're looking at those metrics, those financial metrics, that it should be tied to just taproom revenue alone. So you don't want to look at like, taproom back of house labor as a percentage of total revenue. You want to look at taproom back of house labor as a percentage of taproom revenue. And I think most people get that, but I just want to, make a point of calling that out. And then in terms of POS data and what I think is helpful to look at, I think it's really helpful to look at your product mix in there, because in a taproom environment, oftentimes that's a place where it's the R&D playground and it's the fun beers that go on tap. And there does need to be a place for that, and that's really important. However, I think with the data that you see out of your sales and looking at your product mix, that can help inform you of maybe things that are really popular and you need to consider moving into a more maybe even consider making them a flagship, or something that is more permanent in nature to your rotation. And then also on the other hand, if something is really not popular and it's not moving, you need to know that as quickly as possible so that you can pivot and not get stuck in a situation where maybe your beer is going to go out of code, or if it's an expensive beer to make and it's not popular, let's not do that again. So just looking at that product mix is really important.
Awesome. Great insight there, Maria. Now, Mike has a question for you as well. And Mike says, I'm just getting started with a brew pub with the intent to open next year. Do I need a bookkeeper right away?
No, you don't need a bookkeeper right away. I will say that hiring a good bookkeeper is a really, really important thing, because if you don't hire a good bookkeeper, you're going to pay for it on the back end when you go to get your taxes done. And if your books aren't in order, then it's going to cost you a lot of money to have the CPA clean up your books. And furthermore, if you don't have accurate financials, you're not going to have an idea of how your company is performing through the year. So if you're at that stage of startup and you're thinking about opening, I think number one, make sure that you keep all of your receipts in some orderly manner. And then I would pay somebody to do your bookkeeping maybe twice a year when you're getting through the startup phase. And then once you actually become operational, that's when you need to ramp up the frequency. So once you're operational, let's say bare bones minimum, you need to have a qualified bookkeeper coming in and doing cleanup quarterly. And then as things get, a little more, as activity ramps up, then you'll want to bring the frequency up to monthly. And then once you get fully going, it's going to be weekly. And then eventually you'll hire somebody on full time. But my rule of thumb in terms of hiring really anybody, but particularly accounting staff, is if you can utilize that person for 70% of their time, like if it's a full-time position, if you can utilize them and keep them busy doing what you need them to do for 70% of the time, that's a win. Go ahead and hire them. And if you're not at that point, probably contracting out is a better bet.
Oh, that's fantastic insight on a personal level. I love finding experts who know better than me to handle things that I'm not capable of handling. So good luck when you get there, Mike. And Louise has a question. She asks, what do you recommend as an ideal target inventory weeks on hand for taproom beer and merchandise?
So for your beer production, the way I like to target inventory is if you look at your production plan and if you look at your sales forecast. So let's say, we're here at September 1st. And so I'm targeting what I want to have on hand for inventory for 8/31. I'm going to look at my forecasted sales for September and October and figure out what that means in terms of COGS. So just using round numbers, let's assume it's 50% COGS. And let's say over those 2 months, I've forecasted $100,000 in sales. So that means my COGS for the next 2 months will be $50,000. So ideally, that's what I want to have on hand in inventory at 8/31. I want to have enough inventory on hand to cover the next 2 months of sales. And that's for finished goods. Now, that is like, I want to put a qualifier on that this shifts a lot as a company grows and when it's in different phases of its life cycle. And what I'm describing is more suited for a smaller producer. But as producers start to get larger and they get mature enough so that they can start employing lean inventory practices on a more day-to-day basis, then you should be able to whittle that down. And again, this is related to finished goods inventory. Your raw materials are more challenging because you have to, bring in, especially hops. So let's say here we are at the end of August, and a lot of folks are in a position where they need to bring in the rest of their crop year 20 into their own warehouse. So sometimes you're in a situation where you just have to bring it in, and the inventory for raw materials is going to be higher than desirable, but it's kind of, otherwise you would be paying storage fees. So what I talk about with targeted finished goods is the next 2 months of sales.
Awesome. Thanks, Maria. We've got time for one more question today. And Sarah asked, Maria, you shared a goal for 50% profit margin on merchandise. Do you have any baseline data you can share for profit margin on taproom pints?
Yeah, so the margin on taproom pints for raw materials only is 80%. So in other words, the raw materials of a pint should be 20% of the cost of a pint. If you're charging $5 for a pint, your raw materials are going to be $1. So that's what I look at for over-the-counter sales. Now, I mean, there are other elements to cost of goods sold, such as excise tax, labor, overhead. But when I'm citing that 20%, that's just for your raw materials.
Awesome. Thank you for sharing that, Maria. And we appreciate everybody joining in today. And a reminder, this is part 3 in a 4-part series. Next Thursday, in person, who's going to be there? 4 p.m. Mountain Time at the Lodge by Woods Boss Brewing in Denver. We're excited to kick off CBC week, and we hope to see you there. We have a fantastic group of panelists set up to talk about boosting your bottom line. There's Maria, who's joining us right now, Sam Cruz from Against the Grain, Betsy Lay from Lady Justice Brewing, Jamar Valentine from No Dot Brewing Company, Casey Lefevre from Four Noses, and John Kelly with Craft Peak, and I'll be moderating. We really hope to see you in person. Raise your hand if you're going to be there. And if you haven't already registered, this is my favorite part of these virtual webinars, and I don't know how we're going to replicate this week, next week. Put your phone against the screen and scan that QR code with your camera app and sign up now. But if you can't make it, don't worry, still register to receive the recording. Also, if you're attending CBC, we have a ton of great events happening we'd like for you and your team to be part of. Starting with the panel we just talked about. Following that panel, there's going to be a little happy hour at Woods Boss Brewing as well. Then follow us over to Jagged Mountain Brewing Company for a craft beer professional walks into a bar presented by Arrived in partnership with Jagged Mountain and Lady Justice Brewing. That's on Thursday, September 9th from 7 to 9 p.m. And for a free taste of the signature beer release of a grapefruit Gosa, come to Denver Beer Company on Platt Street Friday night, 6 to 7 p.m. Also, Saturday night, be sure to join us at Great Divide Barrel Bar for a happy hour from 5 until 8 p.m. And once again, thanks for joining us today, and we look forward to see you in person soon. Everybody, have a wonderful day. Cheers.